This is Tom Rowands-Rees, and you're listening to Switched On, the podcast brought to you by Bloomberg NEF. Climate adaptation is no longer just about protecting assets. It's become a question of financial resilience. Rising insurance costs, shifting property values, and the growing impact of extreme weather are increasingly flowing through to city and county balance sheets, with knock-on effects for municipal bond markets. Across the US, climate risk is already reshaping local finances. Counties with high exposure are seeing insurance premiums rise, property markets soften, and tax revenues come under pressure, particularly in regions heavily reliant on real estate for funding. At the same time, differences in climate exposure are beginning to show up in municipal credit profiles, creating clear winners and losers. So, how are climate risks filtering into public finances, and what does this mean for investors watching the municipal market? On today's show, I'm joined by Danya Liu, a specialist in climate resilience and adaptation here at BNEF, to discuss her note, Climate Risk in US Municipal Finances, Storm Ahead. BNEF clients can find this note, along with other related research, by heading to BNEF Go on the Bloomberg Terminal or bnef.com. If you'd like to learn more about how BNEF approaches strategy research on the energy transition, including developments in commodity markets, trends across different sectors, and the cross-cutting technologies shaping the future, you can find more information on bnef.com. And if you'd like to speak with a member of our team about becoming a client, email us at sales.bnef@bloomberg.net. And with that, let's take a closer look at what this means for cities, counties, and investors. Hi, Danya. Welcome to the show.
Hey, Tom. Thanks.
So those of you who are subscribers to BNEF will have access to a note that Danya published recently, and it has the most beautiful colored maps out of any I can ever remember us publishing at BNEF. And we love at BNEF a beautifully colored map. We nerd out for that sort of thing. I'm telling you all this because I know that some of the people on the call are not BNEF subscribers. So you just have to trust me when I tell you that Danya produced these absolutely beautiful maps. And I suppose my first opening question is just broadly, what are these maps trying to show?
Thanks. What a compliment. Although this is an audio forum.
Yeah, I know. That's why I'm in a way we're trying to generate business here, because some people will have heard about the maps and they will be getting in touch with our sales team because they'll want to see them too.
Yeah, go look at the maps. They really are beautiful. The maps show the propagation of climate risk into fiscal risk in very real terms. What we did is used these different beautiful colors to show how each and every single county in the U.S. is experiencing climate risk that then pushes up insurance prices, which then pushes down property values, which then endangers local government fiscal revenue, because, as you know, many county governments really depend on property tax revenue. So we use these maps to just show how precarious each county is to this chain of events that directly links climate risk to fiscal risk and eventually to muni bond markets, which are a huge asset class, not just in the U.S., but globally.
So they're really Danya's Technicolor maps of doom.
Yes.
In a way, they're not representing who's going to get most candy next year. They're really highlighting real world risk. So you kind of have described an entire domino effect of consequences, as you say, of climate risks translating into fiscal impacts. So let's start, I believe, at the beginning of that domino chain, or the end. I don't know which way around it is. It's all interlinked. But let's start talking about property tax. Obviously, property tax is something that affects us all. We all pay it. But you've been diving in a little bit deeper. So explain to us why that is significant in this whole equation you've just described.
Yeah, for me, the property tax map is our last domino, and that it really brings this whole storyline together. I didn't know how critical property taxes were to local governments. Maybe I was naive, but I pulled up the raw data set from the Census of Governments, and I ran it through script and found that there's actually a significant number of counties, especially in this middle band up and down the middle of the country, that take 75% or more of their annual general revenue from property taxes alone, which is huge. I mean, imagine something that comes in and deprecates property values, even a tiny bit, property tax revenue then is how that tiny depreciation in property values then reverberates on local government balance sheets.
And so what we're saying is if anything, and we're going to talk about what anything could be, negatively impacts property values in certain counties that are very dependent on this revenue, suddenly that means things like local services aren't getting funded, schools aren't getting properly funded. And it seems like you're maybe on a slippery slope at that point, because I can't imagine people exactly being excited about buying property in a county that's going through that sort of process, which I also imagine doesn't help property values and therefore the tax revenue either. Is that a fair characterization of what this means when this happens?
Yeah, that's really fair. I mean, once you have something endangering local government fiscal stability, then the repercussions from there become very, very clear. Like I said, municipal debt from those governments, from those issuers could be called into question. You mentioned local public services could be called into question. I have a selfish view on this because my coverage at BNEF is climate adaptation and resilience, which is mainly going to be funded by probably smaller local governments initially. And you can imagine that if their top line revenue is endangered, then probably climate adaptation, these long-term big infrastructure public good projects are probably one of the earliest or easiest to be on the chopping block. And if that happens, that really feeds into the beginning of this climate fiscal risk cycle, which is the dangerous part. If governments are having their budget squeezed and their climate adaptation plans then get chopped, then that makes this climate fiscal risk pathway even stronger. It's a positive feedback loop, a dangerous one. We found that close to 400 counties across the U.S. take 75% or more of their general annual revenue from property taxes alone. So you can imagine that if that is endangered in any way, there's no other viable source to make up 75% or more of your revenue.
I mean, and I saw that number in the notes, and so I just to put in context for those of you not familiar with the US. The US has just over 3,000 counties. So if we're talking around 400 counties, it's more than 10% of counties. So this collectively, if this is, the final domino you're saying is the fall in property values, the fall in county revenues, this is kind of like one of the first really tangible effects. If people are in denial about the weather, and as they know it's all made up, this climate change stuff, then something that is very tangible is these potentially, if there's a mass of county level bankruptcies, I suppose is where this heads. I know you say it's the final domino, but maybe it's the final domino in the first really big financial impact of climate change.
Yeah, I think it's the final domino in this pathway, but it's, in a way, the first domino in a series of other pathways. Like you say, it could lead to local bankruptcies in a worst case scenario, but before then, it could, in a very real way, affect the performance, the stability, the investor perception of muni bonds from these regions.
So there's a lot to care about on the pathway to the worst case scenario, even if the worst case scenario can be averted. So let's get into a little bit more about the different factors that can combine to impact property values in this way. I mean, firstly, how does climate risk translate into the housing market?
There's a couple of ways. There's an acute way, which I think it's pretty easy to imagine, right? A natural hazard comes in and tears through the town and in one go wrecks property values across the board because the buildings just simply aren't there anymore. Catastrophic losses.
Property values.
Right? Yeah, so that's an acute pathway. But what we did in this note is focused on a chronic pathway that in some ways is more pernicious because it can happen anywhere and it is happening everywhere. And because it's chronic and maybe incremental, it's not flashy, even though it is very dangerous. And so this chronic pathway is climate risks, natural hazards accumulating, creating a lot of losses. Insurance providers are one of the earliest and probably one of the best at pricing in climate risks to their financial instruments right now. There's a lot of talk about, private insurers pulling out of these very risky regions altogether, like you hear in Florida and parts of California, because they just can't bear the cost of the natural hazard downside anymore. So these climate risks are being priced in to insurance premiums. As your homeowner's insurance gets more and more expensive, that obviously has an effect on the performance of the local housing market, the local real estate market. And that's a known correlation between insurance prices and housing values. As insurance goes up, housing values tend to go down. And so that's a chronic pathway it is happening. It's not flashy, but it is, like I say, dangerous.
I mean, I don't know why we would expect it to be flashy when we're talking about this sort of doom and gloom here. We expect it to be, I don't know what you say, the mundanity of evil. I mean, it's wrong to call just the physical environment doing what it does evil, but the mundanity of destruction, I suppose.
I like the mundanity of evil, and you've called me the purveyor of gloom already. I like these terms.
I mean, Danya, you are, maybe we need this, someone who's keeping it real with us. And I've read your note and I've thought very hard, if I do decide to settle in the US, where I'm likely to invest in property.
I don't know. Maybe we have a lot of listeners with high risk appetites.
Oh, yeah. So, we can get into that. Where are the places that are risky that the property market doesn't seem to be impacted? We'll get to that. But I feel like there's a question I should ask before that, which is, are we seeing, you mentioned you're seeing insurance premiums being impacted. So are we seeing like a divergence between markets that are, due to their location, high risk from a physical climate risk point of view, and markets that are not? Are we seeing a divergence in the housing markets?
I think so, based on the data that we analyze. So one of those colorful charts that you mentioned at the beginning is our insurance map. So our insurance map categorizes each county in the U.S. into one of 4 buckets: high or low climate risk, and then rising or decreasing insurance premiums over the past couple of years. The vast, vast majority of counties fall into the high climate risk, increasing insurance premiums bucket. On property values, we did a similar analysis, categorized counties into how quickly their property values are increasing or decreasing, so hot or cold property markets, and then on a different axis looked at high or low climate risk. So among hot property markets in the U.S., those that are growing very, very quickly relative to their statewide average, among those hot property markets, 3 out of 4 are located in low climate risk zones, which tells us that, home buyers are already factoring in climate to some extent into their buying and moving decisions.
So when you say growing property market, you mean where property prices are going up more than, say, the less hot markets? Is that what you mean by that?
Yes. Hot markets are counties where the local property prices have grown at least 50% faster than the statewide average.
So is there anywhere where you find the hottest property markets also have lower climate risk? And I'm presuming the inverse is true, that you'll find a higher climate risk with some of the cooler property markets. Are there any exceptions to that rule that are notable?
We found some clusters of low climate risk, fast-growing housing markets in the Pacific Northwest and in the upper Midwest. If you consult the map, you see some of this around Michigan, around Colorado.
All right. So those markets are in a good place, relatively speaking. But there are, I think I remember that there is also some markets that are hot but are higher risk from a climate perspective. So how can that happen?
Yeah, there's obviously many, many, many other factors at play that affect property markets, not just climate risk. Climate risk maybe is a growing small one, but, there's everything from the local economy to the views and, the weather, how close you are to work. So yes, there certainly are markets that are still very fast growing, but are in very, very climate risky zones. And you've probably seen a lot of these articles about beachfront properties in the Southeast that keep going up, even though, we're dealing with more storms, more hurricanes, maybe some sea level rise that is putting the value of these properties at risk.
So for now, it might not be showing up in the property market, assuming that climate change continues to create unstable weather and climate risk. In those regions, at some point, you would see the climate risk playing more of a factor than it does currently.
You would think. That's still to be seen, I think.
So in a way, what your research on this area has captured is the kind of the beginning of what might be a broader trend. You're seeing a bit of a correlation here between climate risk and the property market. It's not universal yet.
Yes, I think that's right.
So when property values weaken, how does it impact, the broader financial systems? I mean, we talked about property tax. I imagine there's broader ramifications than just the property tax and the local government revenue.
Yeah. I mean, there's a reason why housing markets are always in the news, right? They underpin so much economic activity and financial systems. I mean, you think about the mortgage books that are tied to these and how mortgages end up being repackaged and traded. You think about how important housing affordability is to a number of economic indicators. Anything that affects the housing market, I think, is of generally great concern to many, many economists and financial analysts.
So there's a real vulnerability here, not just in impacting local governments and property taxes, but maybe the broader investability of certain areas. So we talked a little bit about the regions that are maybe less exposed, and we're seeing the hotter property market. Which parts of the US would you say is most exposed, both because of the kind of the climate risk, but also, we were talking about a big part of this is how much of local government revenue comes from property taxes. That's the kind of where the combination leads to most vulnerability. Where are you seeing that?
Yeah, on the property tax specifically, it's this north-south band running up and down the middle of the U.S. that is most vulnerable because those counties tend to depend most on property tax for a majority of their revenue. But we did compile an aggregate analysis of all of these risk factors, all of these dominoes, if you will. We looked at each county's vulnerability, not just to climate risks outright, but climate risk as it relates to insurance prices, like we said, housing markets, like we said, property taxes, and dependency on federal disaster aid as well.
So in a way, you're looking at where the dominoes are most unstable, not just where the first domino is likely to fall. If the first domino is climate event, you're looking at where those dominoes are least resilient. I don't know if that's a good metaphor. Let's just run with it.
Yeah.
Less resilient dominoes. And so where stands out, when you think of all of this?
In our composite analysis, the first thing that you'll notice when you open this map is this is the true Technicolor map. There's no broad general trend, really. And that was interesting because that highlighted to us that there's a lot more factors at play. And that's why hyper-local analysis is so key, because you get this patchwork of relatively safe, relatively stable counties right next to a cluster of more risky ones. So that's the first thing.
It's interesting. So we can't make, broad sweeping statements, really, that when you consider all the factors that make particular areas risky, from the fiscal impacts, when you consider everything, you can't just say, oh yeah, it's the Northwest, or oh, it's Texas. It's more like you have to look at every single county as an individual entity.
Yeah. On our composite map, that's absolutely true. It is a mosaic. You can kind of make out general patterns. So you'll see that there's more red in the South, and red in our coloring there was high risk across all of those dominoes, as well as low climate resilience. And then one region of green being low aggregate risk and high resilience, start to cluster around Michigan, Ohio, parts of Pennsylvania, and parts of New York, so Rust Belt in general.
I mean, Detroit for the win. If we're talking about a city that's had to endure that fiscal slippery slope, it's good to know that Michigan is maybe on the right end of this particular equation. I'm curious to know, do you see a big difference between urban and rural counties in terms of the composite risk?
In a couple of the underlying data sets that we use, you can see an urban-rural divide. So for instance, urban counties, more metropolitan counties, they tend to have more diverse economies and therefore more revenue streams coming in. So they tend to be less dependent on property tax alone. And the opposite is often true for rural counties. Also, when you look at the underlying climate risk layer alone, the data set that we use came directly from FEMA, the Federal Emergency Management Agency, and their data set quantifies natural hazard risk via expected dollar losses. So you can see how that shows up differently in urban and rural counties. Urban counties tend to show a little bit higher because, they tend to have denser infrastructure, denser population, while rural counties typically are a little bit lower expected loss due to sparser density.
I know how I've been jokingly saying you've created the Technicolor map of doom, but jokes aside, the research you've done really highlights, as we say, a kind of a domino of effects where climate impacts the world of finance and government in a way that could have very serious consequences. So apart from, making personal investments in the places on the map that you rate as being relative safe havens, what would your recommendation be on how to address this potential domino effect that is waiting to happen? What action, and is this something for the federal government to be addressing, if you can see that ever happening? Is it something state governments should be thinking about? Is it something that local jurisdictions can be taking action on? Insurance companies, should they be doing something different? Do you have any view on what can be done other than, personally trying to avoid putting one's investments at risk?
Yeah, it's a big question.
Yeah, I don't want to put you on the spot. How do you solve?
Okay. I think it's
how do you solve climate change when you can't solve climate change? I suppose is the question.
I think through this research, we arrived at two takeaways. At least I arrived at two takeaways. One that is more physical, so physical climate adaptation, physical climate resilience, whether it be in the form of a seawall or a better drainage system or protecting and restoring wetlands, those resilience services really do have an economic benefit. Just thinking about this pathway that we've outlined, if you have any of those wetlands or drainage systems or seawalls protecting your region, then you're dampening the wobbliness of your domino system. You're protecting more properties from flood or from wildfire or whatever it may be, and therefore you're not triggering the downstream effects of destabilized government income, destabilized financial system, broken mortgage books, what have you. So that's one thing, is we can be investing more in climate adaptation and resilience, and we should be seeing it as an investment in economic protection. The other takeaway is more, I suppose, for the analysts, and it is to make the case that these pathways are real and they're entrenching and they're acting everywhere. I mentioned that we looked at this pathway because it is chronic and it happens everywhere. It doesn't need to wait for a storm or a fire to act. It just acts on its own.
Even the potential for climate disaster is a disaster in a way.
That's right. And so the takeaway is that climate risks need to be taken more seriously in all types of investment analyses, not just for the muni markets, as we've pointed out here, but really, like we said, for mortgage books, for local banks, for local governments. And we need to do better about illuminating these pathways and making the direct link between climate risk and fiscal outcome very, very clear so that analysis can become better.
It's so interesting. And I know this wasn't necessarily in the scope of the piece of research you've done, but you may have a view on it. And it really relates to the first of those questions, these investments in adaptation. I can see how you can make the case that they make sense, but I imagine that when you're trying to make the investment case, and this is big investments of money of maybe not particularly wealthy counties, and it might be invest in this versus some other piece of infrastructure whose benefit is much easier to quantify because, you're building a new bridge. Well, lots of bridges have been built and is a kind of a well-established way of measuring the benefit of that bridge, whereas a seawall or something like that, the benefit, how do you quantify that? You're quantifying against what might happen. And because we're at an early stage in this sort of climate change journey, I imagine it's difficult. So is there a way around that? I mean, firstly, is that an actual problem I've just identified? And do you have any view on how that can be addressed?
I think it is a problem. A lot of people, when working with climate adaptation, point to this problem that we have a hard time identifying bankability. We have a hard time assessing when a project is bankable. Part of the reason is, like you've identified, a lot of these protective infrastructure projects like a seawall, they don't come with a revenue stream. So how do you make your money back if there's no revenue associated with it? There's just avoided lost revenue. So I think that is an issue that many people are working on, and that's why more data helps. And more analyses into how all of these things are connected, that really does help.
What you've described, it really rings a bell for me, because early on in my BNEF career, my area of research was energy efficiency. And the companies selling energy efficient products and services, trying to go to a building and say, we'll put in new windows or do all sorts to reduce your energy bill, and it's a total win. The thing they always said was the struggle is that although you can show that the financial benefit is real on paper, in practice, there's no actual revenue stream.
Yeah.
There's a revenue stream versus a counterfactual where you didn't make the investment. And that quickly evaporates in most sort of fiscal analyses. Now, in this case, it's even more complicated because the counterfactual is something that might happen. I mean, you don't invest in energy efficiency in a building, then your energy bill will definitely be higher. If you don't invest in climate resilience, you might be vulnerable to an extreme climate event if it happens. So it's a possibility within a counterfactual. So I guess answers on a postcard, if anyone has a smart financing structure that can deal with that and make it palatable. We can all agree, I'm not saying we do all agree, but even if we were to all agree that this makes sense, it's still going to be hard.
I will say that we do have a little bit of a sliver of light on what the counterfactual looks like, because we starting
need a sliver of light in this podcast. I want to hear all about it.
We are starting to become much better at accounting for the economic losses from climate damages alone. Our colleagues at Bloomberg Intelligence do a great job of this. They have a climate damages tracker globally, and I believe by their last accounting in 2025, globally, we lost $1.3 trillion based on climate-induced damages. So there's a little bit of your counterfactual, right? And that's kind of in a best-case scenario, thinking that climate change doesn't get any worse than it does today, losing $1.3 trillion globally per year. And then the other point is, I think when you bring up adaptation and resilience investments, people tend to think about these huge, mega multi-year projects. And in some cases, that might be needed. But there's also a wide variety of other technologies, other solutions that can help and can make a difference, that are much easier to implement, cheaper to invest in and fund than those types of projects, right? There's a lot of science behind how beneficial early warning systems are, right? If we can get a couple hours prior notice to how bad a flash flood is going to be, or a storm or a wildfire, that saves a lot.
That's a really interesting and I think important point, because, when I was saying what I was saying, it was under the assumption that we're talking really big investments that, are going to be paid for over many, many years. But what you're saying is there's actually some pretty easy stuff that can be done so long as there's the will to do it.
I think so. There's your glimmer of hope.
Well, let's end on that positive note, that although there is a stack of very wobbly dominoes waiting to fall, there is plenty that can be done to fix them in place and maybe mitigate or even avoid this potential cascade of consequences from climate change on the US economy. And I'm sure that there's equivalent stories in other countries as well. Danya, it's been an absolute pleasure having you on today. And it's a really new frontier of research for us at BNEF. So those of you who do have access, I really strongly recommend you check out Danya's research on this topic, because I think this is going to be a really important conversation going into the future. So Danya, thank you so much.
Thanks, Tom. The pleasure.
Today's episode of Switched On was produced by Cam Gray with production assistance from Kamala Schelling. Bloomberg NEF is a service provided by Bloomberg Finance LP and its affiliates. This recording does not constitute, nor should it be construed as investment advice, investment recommendations, or a recommendation as to an investment or other strategy. Bloomberg NEF should not be considered as information sufficient upon which to base an investment decision. Neither Bloomberg Finance LP nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the information contained in this recording, and any liability as a result of this recording is expressly disclaimed.